John Lonski joins me now. So, John, so far, the spike in oil prices hasn't really spilled over into the core inflation that is taking away food and energy. And that the Fed does seem to still think that it's something that you can look through, that it's not going to be long-term affecting the overall economy, to which you say what?
Yeah, and I think the Fed and the markets expect that the United States will succeed at getting Iran to curtail their development of nuclear weapons, open up the Strait of Hormuz, and as a result, we'll see oil prices come down rather rapidly once this is achieved. Now, the impossible thing for me to do, for anybody, is to predict exactly when Iran will agree to ceasing the development of nuclear weapons.
You can't predict what crazy people are going to do next.
Precisely.
I mean, that's the problem. However, there are futures markets, and they do see this steep drop-off in prices coming down as soon as something is resolved.
That's true. That's very correct. I want to add something else that I think is important. Today, we had the average retail price for gasoline came out. It was $4.17 a gallon. Well, that's up from maybe $3 per gallon we had a couple of months ago. But the reality is that price for gasoline is still well under its 2002 high of more than $5 per gallon that we had for a couple of months under Joe Biden's energy policy.
Now, is that the real price? Because when you factor in inflation, it was actually higher than that.
Yeah, and I want to add something else. We look at the price of a gallon of gas as a percent of the average wage. Right now, it's at about 12%. Back in 2022, it was much higher, 16, 17%. And the last time we had a real recession, not a COVID recession, the Great Recession, 2008, 2009, the price of gasoline was approaching 20% of the average wage. We're well under that.
I want to get you on the Fed because now that Senator Tillis has pulled back his hold on Kevin Warsh's nomination, and there will be, presumably now he will become the Fed chairman once the Senate starts to take a vote on all this. What do you think the new Warsh Fed will look like?
I think the new Warsh Fed is going to go out of its way to make sure that we have price stability. It may put a little more emphasis on price stability than having full employment. But on the other hand, if the economy were to weaken significantly, the Warsh Fed will be quick to go ahead and cut rates. I want to, another important fact, very important fact, the Warsh Fed is not going to have the Federal Reserve get involved in matters related to DEI, okay, or
Thank
whatever.
goodness.
ESG.
That's not
So that's
its role.
Yeah,
Good.
that's gone. Their function is price stability, and full employment. These other matters don't.
And one thing we know that Warsh wants to do is to work down that portfolio, the $6.7 trillion portfolio that the Fed has, which they've used essentially to manipulate markets. It started, maybe some people go way back to 2009 when it started, but it really increased during the pandemic. He wants to get rid of that portfolio. How will that affect markets?
Well, Warsh is going to take every opportunity to go ahead and reduce the Federal Reserve's holdings of Treasury securities. He may not want to do it right now because we do have a situation where Treasury bond yields are a bit on the high side compared to what's taking place in the underlying economy. He doesn't want to do anything to push mortgage yields higher at this point in time.
Right.
But when that opportunity arises, he's going to be quick. His Fed will be quick to take advantage of it.
We should mention about $2.5 trillion of that portfolio are mortgage-backed securities. So that might affect housing in a difficult way once he begins to draw it down.
My own personal opinion is that housing is going no place until we get that 30-year mortgage yield well under 6%.
Absolutely.
And that means that we have to have maybe the 10-year Treasury yield drop by at least half a percentage point from where it currently resides. Unfortunately, when I look at the outlook for the 10-year Treasury yield, most believe that the 10-year remains above 6% well into 2027.
John Lonski, a lot of stuff there. Thank you very much. We're going to all have to digest it.